Sweet. Okay. All right. All right. Welcome everybody to the Young Investors Club's 8th General Body Meeting. My name is Brandon Fonseca, and I'll be hosting the main topic of this meeting. So let's get started. So here's some of the announcements that we'll talk about. So membership, stock market game. You guys kind of know the gist of it. So membership dues, I'll talk about this since Alejandro is currently not here. So membership dues is $15 for the semester. Pay through Venmo or Cash App. And please put your first name, last name, and nice email. And then stock market game. For those who haven't joined the stock market game, guys, pretty good time to join. Who knows what the dip is? I feel like you guys can pretty much clap everyone else that just joined a week ago. So it's best you start now. So here's like the little QR code. If anybody wants to scan it and join the game. The password is YIC2020 YIC 2020. Give that a minute, a few seconds. And then, some of the prizes if you get, the game ends next week and the prizes are $25, $15, and $10 Amazon gift card. Pretty interesting week. I really want to see the returns. I should have pulled that. I'll pull it up later, but it's been an interesting week. So book of the week, Danny will be presenting on that.
Awesome. So before we did a book a little while ago called The Big Short, which I'm sure you guys either have read the book or watched a movie. And like myself, that's probably one of my favorite books about finance and movies about finance as well, how it dives in deep to the financial crisis. And for anyone who's listening and watching that likes the history surrounding the financial crisis, I think this book is a very good book because the difference and similarities between The Big Short and Too Big to Fail is that The Big Short focused primarily on the corporation side of things, like what were the bankers doing, what investments were they doing, and things of that nature. Where Too Big to Fail is more emphasis on the regulation side of things and the government side of things and their responsibility during the financial crisis. It also talks about the banks like Bear Stearns, Lehman Brothers at that time, JP Morgan Chase, and it has a lot of great actors in it as well. Paul Giamatti from Billions or Big Fat Liar, if you guys ever watched that movie back in the day. Topher Grace, he's from That 70s Show. James Woods, probably wouldn't really recognize his face, but he was Hades in that Disney animated movie Hercules. If you remember his voice, he plays Dick Fold, who was the CEO of Lehman Brothers before it failed. And ultimately, this book is written by Andrew Ross Sorkin, who is also on Squawk Box, like the guy up top, if you've ever seen his face. He's on CNBC. He also has a column with I think it's the Washington Post, or no, Financial Times, that's what it is. But yeah, he's a very good reporter. I love listening to him speak, especially when he interviews big bank CEOs or big tech CEOs. He always hits them with those very thought-provoking questions. So if you're interested in any of this, I would look up Too Big to Fail. It's on HBO Max if you have HBO. Or you can just casually go on YouTube, type in Andrew Ross Sorkin interviews or Too Big to Fail YouTube videos, and they'll have little short YouTube documentary series clip things on YouTube where you can watch 40 minutes of just interviews from people that were directly involved in Washington during the financial crisis. I wish I had the video on hand, but there's interviews with George Bush, Barack Obama, Ben Bernanke, who was chairman of the Fed at the time, Timothy Geithner, Hank Paulson, who was Secretary of the State during that time. So there's a lot of great information in this book, and you can find on the internet as well. And that'll be all.
Thank you, Danny. So next topic I want to talk about is board elections. So that will be happening on December 2nd. And here are all the positions that are open. So pretty much every single position is open. Pres, VP, Treasurer, Secretary, CFO, CIO, CMO. If anybody wants to ask like a question about it, like what each one does right now, please do so. But some positions that nobody has applied to yet are Vice President, Secretary, and then CFO and CIO. So those four are for the taking. So if literally one person runs for, let's say, secretary and no one else runs against them, they're by default secretary. So no competition there. And then for vice presidents, that kind of goes down to when if there's more than one president, more than two people running for president, the loser would be gone into consideration for VP. And so anybody else that just applied to VP would be competing against them too. But yep, December 2nd, and then there's a Google form on the Slack that shows like how to sign up and how a presentation will be run. Okay, someone asked, what is the CFO position role in the Young Investors Club? So the CFO role, it's exactly what Garrett does right now. It is handling the workshops. And it can be whatever topic, but typically for CFO and CIO, we prefer to have somebody who's kind of like an expert in a certain area, whether it be, for example, for Alvaro, he was an expert in Forex, so he talked about Forex as CIO. So CFO and CIO, they're kind of similar. They're just kind of like titles for officers.
Do you want me to add a little bit to that, or?
Yeah, if you can, Garrett.
So essentially, it's like if you feel like you have a lot of knowledge in a certain area of the market or some kind of market, commodities, stocks, if you want to talk about bonds, but if you have like a pretty good understanding of those concepts, and you also have some other things that are personal to you that you want to share to the club, and you feel that the knowledge that you have can value other people and you want to share that, then that's really the role of the CFO and the CIO positions. And then obviously you get to help out with some of the presentations, which is actually a lot more fun whenever you're in person and all that. And at the end of the day, it's really all just a learning experience. And I plan on staying on the board, and I know a few other members are going to be in touch as well. So whatever you guys need, we're going to be there to support you guys and help you thrive.
Yeah. Someone asked the role of VP. It is literally the exact same role as president. So if there's any situation, like let's say, for example, there's like some family emergency, I can't attend the meeting, or just anything that I physically cannot do, the VP can do. That is pretty much what the VP does. Other things like, let's say, for example, I want to go get funding and I need to attend a meeting with SGA and I can't attend it because I have work. I'd ask Chris, I'd message Chris and say like, hey, Chris, can you attend this meeting? Because Chris has the same authority as I do. So anything the president can do, the VP can do. So in terms of VP, it really depends on the situation. But so just whenever I need an extra hand on any tasks, like let's say Chris, for example, he makes the Kahoots for me because I don't have time for that. Because I work on the slides and I also work on, I also have like a job, other things. So I have a lot of them on my hands. So the VP kind of manages, or like kind of takes off the load from me. I don't know if Chris wants to add anything to that. Chris, you good? He's in here, but okay, I guess he can't respond. But yeah, if you have any more questions about that, just reach out to me or Chris. Oh, Chris, I can't hear you. I think your mic is off or it's not working. Oh, can I mute? No. Anyways, Chris, you can answer in the chat. I'll try to continue. Okay, gotcha. All right. So the next part is our market recap. So Garrett will be running that.
Hey yo, and a fun day actually a fun week so far, guys, right? Volatility is always, something that can make us, cringe, or if you're betting against the market when it spikes, you can be very happy. But man, these couple days have been a roller coaster. Monday was down, and then Tuesday we rallied back in a little bit of dramatic fashion on some select names, and then today we opened down and we didn't rally back in the slightest, which is pretty ugly. Next slide. And then I actually stole this line from the 1987 crash. And Randy, could you actually refresh the slideshow real quick? I added a couple more tidbits in here. Sorry about that. But yeah, it's just been a very challenging time in the market. And so if you're not careful, I'm going to go over a couple things here. If you're not careful, it can either be a really scary time for yourself and emotionally if you don't have a plan, or it can just be another time of opportunity, which we'll go over a couple of those today. But I think the big story today really started throwing some fuel on the fire was Germany and France starting to shut down again. Another 4 weeks of limiting, economic activities, pretty much no bars and limiting restaurants. I think shops are still staying open in select areas, but that's not a good sign to see, and that means that they're really starting to take it serious again over there after getting a little bit lackadaisical. The S&P, Nasdaq, and the Dow, it was ugly across the board today. It kind of reminded us of the February of late February, in my opinion. Down almost about 3.5% on the SPY. Nasdaq down almost 4% today, and then the Dow kind of finishing in the mid range there. Just not pretty so far. And I have a chart of the index. We're doing the 2 slides from now. One more. I'm sorry. Can you go back one? Sorry. But anyway, so as far as bringing things down a little bit, the leading stocks today really started taking some heat. You have Microsoft going down, you had AMD going down. Just not pretty. So some of these high-flying stocks are finally being reeled in. And I didn't get a chance to look at Tesla, but I'd imagine Tesla got dinged pretty both. Yeah, about 4.5% on Tesla almost. So just a lot of these lean names finally pulling back in, and with the other things going on with the elections coming up and still uncertainty over the virus, and especially with no stimulus coming in, just there's a lot of fear out there. And I think that's really why we started seeing that sell-off, especially in the last 5 or 10 minutes of the day today. As far as the next part goes, I'll show how the markets are kind of interpreting the upcoming election in terms of which market direction. And so if we want to show that next slide now. Essentially, this is a study from 1990 to 2016. And pretty much when the market rallies going into an election time, it usually signals that the Republican Party is probably going to win the election. That's what the polls are saying. And the market usually likes to reflect that. Well, here what we're seeing lately, and I'm not saying this is completely driven by the election, because we do have COVID, we have other factors in the making, a highly leveraged economy right now. But usually when the market sells off this close to the election, it's usually a sign that the market's expecting a Democrat president to go ahead and get into office. And so whether it's wrong like 2016 was, begs to be asked and all that. So you don't know until it happens. I mean, we could get a surprise win from Trump again and things go back to normal. But right now, it's just, I don't know if I really want to gamble on that. I mean, especially from how bad the polls are from last time. I was looking at, just out of curiosity, on 2 days ago, on that date in 2016, they had Trump behind 38 to 50 behind Clinton. And so considering the race may be a little bit narrow now, it's just so much uncertainty out there. And I don't know if I'm really willing to gamble on that right now. And then next slide, got a couple more things to show you guys. As far as the summary goes on the indexes, it's just ugly action. We saw no buyers into the close. We saw that ugly trend when fear can really encapsulate the market, and you get the last 5 or 10 minutes that just completely push the floors even lower. So we saw the indexes breaking through their intermediate term moving averages today. And now, as far as easy dollar, the type of I can't talk right now. The type of market environment we're in, it's no longer that easy dollar environment like we had from the April to September. And it goes to show if you drew a line down the high of the SPY from 358 and just draw a vertical line, there's a complete difference in the personality of the index. It's no longer higher highs, higher lows, and rocket stocks as we talked last week. It's just a much more challenging environment. Now we're breaking down. If you look over here on the charts down here, throughout this correction in the index, we had some red flags. The initial pullback happened on high volume, and usually that's typical whenever a market or a stock pulls back. The initial leg usually does have higher volume, but then on the second leg down, still in the initial stages, we had another influx of volume on the downside. And then we had that nice little 2 or 3 week rally, but if you notice, we didn't really have any high volume up days. And so the institutions and the enthusiasm that we had prior to that wasn't really there. So that was a red flag. And then now, last week we talked about how it could have been forming a cut with handle and a cheat pattern, but we were waiting for that confirmation to really see if we could get rock and roll again. And the market's clearly chosen a direction, at least in the short term. We are in a challenging market. We could be going into a stage 3 or a stage 4, and those can last, anywhere from weeks to months, depending on how long it takes for the fear to settle out of the market. So it's not an easy dollar environment right now. And so on the next slide, I have a little summary on how to handle the situation. And a lot of this is stuff that we've been saying for the past, a little over the past 2 months. It's just been repetitive. If you're using the swing trading approach in the workshops, it's a very selective market. Unless you have a play that you want to be in, and you're okay with maybe taking a little bit of added risk because of price shocks and potential gaps from news, it's not really the time to be aggressive. We pointed out Chewy in the last workshop and how it's finally forming that pivot that we were looking for. That one broke out today. So if you're watching that stock and you wanted to own it, that was acceptable. It broke out in good volume, and especially on this week of a day in the market, that tells you that there's some strength in that stock. So that's definitely one worth keeping an eye on to see if it becomes the next leader in the next market cycle. If you're holding positions, just follow your stop losses, guys. If you have a position that's kind of marginal, fluctuating between where you bought it, but you still want to give it a chance, don't get emotional just because it gapped down a few percent. Now, if you gap down 5 or 6%, you're at a loss. That's a completely different case. But if your stock is holding above your stop losses and still has a chance to make you a profit and it's still acting like it should, I wouldn't be quick to just cut those off. In a prime time example, I actually have a tale of two sides. I broke a rule on forward, and I follow my game plan on Pinterest today. And Pinterest ends up gapping 20% higher on earnings, so I was really happy about that. And the reason I didn't sell that one was because I had a decent profit. The stock was still fluctuating and holding above its most recent low and a high consolidation point. And I figured if the stock, even if the stock gapped down 20%, I would have only been down about 7% on my position. That's an acceptable risk. But I stuck with that game plan. It worked out. Now on forward, I got a little cold feet. I was like, okay, well, the market's pulling back. Forward's only at a 1% profit for me. Let me go ahead and just chop this thing and move on. And in hindsight, it's always 20/20. The stock curve got down because Ford had worse sales than usual, but Ford's slowly coming back, getting into a new electric vehicle market, so they have a lot going for it right now. Now, if you're a long-term player, you can take advantage of these massive sell-offs and all that. Like, I think really adding aggressively here to your long-term account really depends on your perspective. If you think that COVID's overblown and that there's no way that the United States is shutting back down, then I would take advantage of some of these small cap names, which are not going to be shutting back down, but continuing to expand their business as the economy reopens. Now, if you think that that it's going to be a little bit longer thing, you think we're going to break through those September lows, then yeah, definitely take a little breather. But for a long-term account, in regards to buying and holding 10, 15 stocks or an index fund, I would definitely take advantage of these pullbacks to add a little bit more money in, because when we finally break above the September high of September 2nd, and the market enters that new bull phase, you're going to have all that capital kind of acting as a spring effect. So when we finally go back up, you'll have, the same, you're not waiting for that new high to add and you miss all the compounding that could be done at a lower price. You're going to be getting all that cheap money, essentially, from a value entry, and that can really spring your portfolio higher in the next bull run. But the bull run will be back. Corrections happen. Peter Lynch has an excellent video on YouTube explaining that corrections happen every like 2 to 4 years, and the normal. It's just a part of doing business in the marketplace, and you have to be ready for them.
Awesome. Thank you, Garrett. That was awesome. So let's start our Kahoot game. Okay. Give it a second. Awesome. I should lower the volume. All right, guys, Kahoot is up. Again, whoever gets first place will get a $10 Amazon gift card. I hope you guys read the news today, because a lot of it is on that. All right, let's give it a minute. Let's see, there's 26 people here. Let's see how many joined. We're at 14. Is everybody? Nope. Okay. I hit forward. Oh god. $17. All right, I'm gonna give it 15 more seconds. All right, no one's leaving, no one's joining. 5, 4, 3, 2, 1. All right, let's start. Awesome, it is AMD. You guys are getting a lot better at this. All right, good job, Peter and Jahar. Guys, you gotta know what kind of motorcycle that is. It is a Harley Davidson. Nice job, Peter. Oh wow, both of you guys are tied. Oh my god, you guys are answering at the same time. Wow. Okay. No one ever heard of this one. This one, I mean, yeah, it's very interesting. Yeah. If Novavax or Pfizer failed, bro, it would be on national headlines. It is a small. It's called Eli Lilly. Jesus Christ, Jahar. He knows his shit. It is Microsoft. Oof. Can we kill his streak? For me, this question's pretty hard. I don't know why you're getting them. It is GameStop. All right, someone's catching up. Little hint, they already have bad enough news rep. That's right, guys. It is Boeing. All right, good job, David. Bro, if anybody bought this, you like a few days ago, oh my gosh, making straight bank. The thing I would never short right now. It is the VIX, Volatility Index. Job's wrong. Awesome. It is AT&T. Oh my gosh. Jar is back on top.
Go.
Made the comeback. All right, this one's pretty hard. Let's see. Can't find this on Wall Street Journal. Wonder how many people went to pub last weekend. Wow, you guys actually did this pretty well. Okay. Yeah, it's 110. Okay. All right, Jahar. Might get the last one. Let's see. Yeah, he's probably gonna get it. Awesome. Great job. ESG, environmental, governmental, social governmental. I hate for it. I don't know who that is. I'm assuming it's Nicholas or Garrett. David in second, and Jahar in first for the millionth time. Hey, congrats.
Thanks, man.
We'll make sure. I'll make sure Alejandro sends you over the gift.
All right, sweet.
All right. Cool. All right. So let's get to the next topic, which is ESG investing. So just wanted to get public opinion. What do you guys think ESG investing is? You can say in the chat, or you can unmute yourselves. Nobody knows what it is? All right, well, this is what the meeting's about. So talk about what ESG investing is. It's also known as sustainable investing. It focuses on E, which is environmental, S is in social, and then G is in governments. So environmental, it would mean conservation of the natural world. Social means consideration of people and relationships. And then governance would be standards for running a company. So when it comes into investing, the notion that when you can make money in the market and feel good, it's very interesting kind of dynamic here, because a lot of people our age, they want to, invest in a company, but also kind of feel good about themselves, like help the environment, or social justice, better wages, all those social, environmental, any kind of issue that people our age or these days care about. That is ESG investing. And the most popular demographic is pretty much us millennials, as well as Gen Z, as well. And key reason why these three, environmental, social, and governance, is like more common these days is, well, a lot more people want to invest in it. That's just common sense. So a little more on it, pretty much the general definition of it is it's an umbrella term for investments that seek positive returns and long-term impact on society, environment, and the performance of business. So we're going to talk about each specifically. So environmental factors. Here's like a little list of it. So climate change, pollution, biodiversity. So that means having more species. Nobody wants any animals to go extinct, obviously. Deforestation, energy efficiency. So conserving energy, using less coal, less oil for power plants, using solar instead. Waste management, how they actually, like, for example, iPhone, if they get their if you trade in your phone, iPhone gets it back and tries to reuse some of the parts for it. That's kind of like waste management. And then water scarcity. If any of the companies that use water a lot, like let's say coal plants, power plants, say OUC, they have a coal plant, they use a lot of water. What you see coming out of that giant plant south of campus is steam coming out. It's a lot of water. That's water scarcity. Some companies, I would say, even gold mining companies, they use a lot of water for filtration. So those kind of things, we don't want to deplete resources. Using less is good. So trying to give a little more deeper answer to this is why people look into this is, environmental risks that are created by these businesses. They have an actual or potential negative impact on whether in the air, in the land, or in the water, ecosystems, or even our own health. So a lot of companies, they try to perform environmental activities considered in these ESG factors, considering, let's say, they manage their resources, they try to prevent pollution, reduce emissions, climate impact, executing environmental reporting, those kind of things. The factors, so people look at this because it determines a company's stewardship of environmentalism and the focus on waste and pollution. It's a very, let's say, like a feel-good thing. Like some people, they're really against, deforestation. I can give you some companies as well. So let's say, for example, Apple. So everyone know the iPhone 12 got announced, and when Tim Cook was talking about how the iPhone cases were being distributed, the boxes are a lot smaller. So everyone's used to, when they buy an iPhone, it's a really big, giant, rectangular cube. And then now they try to shrink it down to just the iPhone and the cable. And the reason they said so was it's, less waste. Some people might dislike that you're not getting that charging port, and it's a smaller box just because of that. But also at the same time, it is, it's waste management. They're using less materials for their boxes. And some people, they actually like that. Apple is actually trying to be more green in the activities that they do. Some bad things, let's say. So there's a company called Oatly. I don't know if anyone's tried their almond milk before. So Oatly, they are owned, they have a stake. BlackRock has a stake in Oatly, and I believe it's Blackstone, actually. I'm pretty sure it's BlackRock. So BlackRock has a stake in Oatly, and some people, they don't want to buy Oatly because BlackRock actually also has a stake in a company in Brazil that, a construction company in Brazil that kind of causes more deforestation. And And a lot of people, they don't want to buy Oatly because of that. You can kind of say this is ESG as well, to Oatly and to BlackRock, because they're associating with these kind of companies. But those are the kind of things people think about when you think about ESG investing. Is investing in this asset, is it going to affect the environment? That's as simply said. So the next topic, next letter is S. So social. So let's say how happy the customer is, how happy the employee is, diversification, having like a more balanced amount of men and women in the workplace. The things that affect people, whether it be customers or the workers, that is social. And the companies that treat their workers well, give good wages, promote health, safety, better labor management, protecting human rights, focusing on product integrity, social positive outcomes, including, let's say, increasing productivity and morale, it reduces turnover, absenteeism, and improves brand loyalty. People like companies like that. People will invest in companies that a lot of people like, even the employees like themselves. Let's say, for example, Amazon. I believe they have like a really good reporting system. If anything, if someone spoke, if anybody has an issue,
call.
Garrett. I'm going to continue on, but anyways, so the social factors pretty much look at how a company treats its people and focuses on employee relationships, diversification, working conditions, local communities, such as, let's say, donations to a certain fund, charity, and the health and safety of its workers. So anything that, the company does, let's say they donate $1 million, $2 million to a charity that helps the homeless. That is a social factor. People like that. They're considered an ESG company, or just they fill out that S factor in the ESG because they do some of these activities. So governance. So governance risks, they concern the way companies are run. So it addresses areas such as corporate brand, independence and diversity, corporate risk management, let's say, compensation. So how much an executive is paid compared to how much a worker is paid. And through company governance activities, such as diversification and accountability of the board, protecting shareholders is their right, and they also want to, disclose and be as transparent as possible to their investors and the employees and everyone else. So governance factors, they take a look into the corporate policies and how the company is governed. They focus on, like, let's say, tax strategy, again, executive pay, donations, political lobbying, corruption, bribery, board diversification, and structure. So a little example on governments, let's say Juul, which is owned by Altria. Juul, they don't, like back in the day, they had a bunch of like high schoolers, teenagers buying their Juuls. And some of their ads, they had a lot of people, really young people, taking a Juul hit. And a lot of people didn't like that. It kind of promoted a lot of young people to, Juul, as, people say on the news. But Juul is actually a really, really heavy lobbyer in stopping people from buying their products, believe it or not, and telling people not to buy their tobacco. Same with Altria as well. They try to help with ways to find different ways for, not buying their cigarettes, try different alternatives. Altria is giving effort to, a factor that a lot of people like, and that goes into lobbying. Compensation, how much an executive is paid. You guys probably heard of like how much Elon Musk has gotten in stock compensation. But yeah. I'm sorry, I'm reading. Someone said, I invest in Altria long term. Some people say it goes against ethics. Yes, so I was going to go a little more into that. Is it's tobacco. It kills people. Not really kills, but it does kill. But it's very unhealthy, and it can kill people if you just smoke it in excess. People say, Altria is not, and it's not considered ESG because of that factor. Some people do because of the other things that they're doing to, mitigate people smoking cigarettes or hurting them. The fact that they're actually putting in effort to reduce risk or benefit the health of society is good. Because Altria, they're a tobacco company. There's no going around that. They go out of business if they literally stop doing what they're known for, which is selling tobacco products. So exactly why do people buy ESGs? Why do they buy ESG ETFs? Pretty general to say is a lot of people, they care about where their money goes. They want to know, hey, if I'm buying money in Goldman, how's Goldman spending their money? Where are they actually donating their money to? People actually care about that, believe it or not. They care about how it affects society, what they're doing. A lot of people, they care about what their money's going into. Not just they don't care about not just the returns, but they care about exactly what they're buying, because they think some investors, they think the assets kind of represent their principles, their thoughts. And that's what goes into ESG investing. Many investors, they're not only interested in financial outcomes of their investments, they're interested in the impact of their investments and the role their assets can have in promoting global issues, such as climate action or social justice. One demographic, obviously, is going to be the millennials. I can give you a little example for this. So when, the Black Lives movement happened a few months ago, a lot you could see on maybe some people's Instagrams, they're kind of pointing out some people that weren't standing up for the Black Lives Matter movement. And some people are saying, oh, let's boycott it. And then some people are oh, let's sell their stock. We don't even want it. That's what I mean by ESG. There's some actions the companies does that the investors do not align with. And sometimes some people just want to invest in assets, they can relate with, or, the values of a company they agree with. So another thing is green business is good business. And I don't mean in an environmental sense. So companies that prioritize environmental virtues, such as reduce carbon footprints, they can be less exposed to commodity prices. They use, they could use cost-effective, cleaner energy sources for their offices or for their warehouses. These companies, they can save capital and bolster their cash positions. Companies with strong governance track records, they often are backed by solid management teams that displayed an ongoing commitment to shareholders, and they also keep the balance sheets really clean, which a lot of accountants, a lot of investors, when they're looking at the reports, they like that a lot. Additionally, these companies, they're likely to have more diversity on their boards, even among the C-suite executives. And a lot of historical data, it kind of indicates that companies with increased gender diversity in key positions, a lot better response times to, let's say, any issues, let's say harassment in the workplace or technical IT issues, any issue that they're very responsive in. Those kind of things help make those companies outperform than their competitors, less diverse companies, male-dominated rivals, those kind of things. So I'm pretty sure if anyone's ever heard of ESG, they might have also heard about social responsible investing, and they're very similar. But I want to talk about the main differences in them. So ESG investing, it considers how a company's adherence or lack thereof to certain standards might affect its performance on the market. So how they follow the rules, how they follow their environmental policies within their own company, it can affect the stock. So let's say how the fact that Apple is having smaller boxes because the reasoning is they want to be more friendlier to the environment. That's ESG investing, because they're doing an activity that they believe that they believe that will increase the performance of the stock because they think that more people care about that. That can be a reason for ESG investing. SRI investing can include the practice of actively not investing in certain companies or funds because they don't meet certain standards. So like, let's say, like Nick was mentioning, Altria, some people don't want to invest in tobacco companies because, you know, it's bad for your health. And let's say some people don't want to invest in oil and gas companies because, you know, it causes pollution. SRI investing means, you know, excluding companies entirely because of their activities. Whereas in ESG, you can buy Altria and you can buy ExxonMobil if, you know, you can see through the ESG analysis that, you know, they're actually doing activities that are beneficial. So, you know, it's no surprise that SRI and ESG are, you know, really confused. But, you know, after all, both methods, they're considered, you know, the wider perspective of social and environmental implications of an investment. So I wanted to talk more on, you know, the performance of ESG investing. So I wanted to go in here. So this is Vanguard. Vanguard actually sells ESG ETFs. So pretty much companies that they believe that fit, you know, their definition of ESG. So if they mark all these, most or all these points, they're considered an ESG company. And then here are some of the assets that Vanguard does sell. And I want to go for a mutual fund. I'll go for the ESG US stock ETF, which is ESGV. And then we can go here just to show you guys like how to navigate through if you ever want to do research on ETFs or anything that Vanguard sells. So here's an overview of what they do, what they have. And I want to talk about, you know, their portfolio management. So here's the portfolio, and then every ETF, they always tell their strategy for their ETFs. So right here, this is their investment strategy when they're creating this ETF. So what companies they're putting in this specific ETF and their reasoning why. So as you can see, there's criteria that they make. They make it by an index sponsor, which is independent of Vanguard. So someone else is doing this for Vanguard. They just tell Vanguard, hey, these are the companies you should invest in, or like, here's a list. So for example, any company that produces adult entertainment, alcoholic beverages, so no Truly, no Boston Beer Company, produces tobacco products, no Altria can be in this ETF. Chemical, biological weapons, nuclear weapons, I don't know, I guess Lockheed? No, I don't know if Lockheed makes nuclear. Any publicly traded stock that pretty much does any of these things, produce weapons, produces oil, gas, makes firearms, ammunition for non-military use. These are all factors in the strategy. This is exactly what ESG investing is, and as well as SRI investing as well. There's these certain factors that they put in, and they try to see like, hey, what stocks actually fit in to this role. So I'm like a little thirsty. Those are the kind of things. So one might say, why should I invest in this kind of ETF? What will it beat the market? Will it not? Like what's the point in investing in something? Even though I feel good, will it make me just as good as returns as investing in, you know, the SPY, the VOO? Well, guess what, guys? I'm about to show you. So here is the Vanguard, the ESG US stock ETF, like I was showing earlier. And I'm going to use Google Finance for this, and I'm going to compare it against a really popular one is the SPY, so the S&P 500 ETF Trust. And you can see right here, the Vanguard, so the ESG ETF is in blue, and the S&P 500 ETF is in yellow. One's doing it's trading a little higher, but in terms of percentage change each day, each second, they're very similar. And then we can compare it with Vanguard's traditional S&P 500 index. A lot of people, honestly, like, you guys should buy this. This is probably my favorite ETF to buy. But again, when you compare it, very similar in how they move. And they have a couple companies that they just avoid. They don't have any Exxon, they don't have any BP, no Altria, as what Vanguard does. And I can show you exactly what the main stocks is as well. So it's largest holdings. It's very similar to Vanguard's traditional VU index, Apple, Microsoft, Amazon, and it doesn't show the weights on here, but these 10, all 10 total, they total to 27.9%. And the top ones, the top three, they're all tech companies. It's kind of the reason why the returns are so high is they're putting a lot more weight in tech companies. Same with VU and same with a lot of other ETFs because, tech is kind of like the biggest industry right now that's growing. Oh, they even put Tesla on here too as top 10. That's a new one. But when we talk about this and when we talk about risk, they're very similar. And if anybody, even I would say, would want to consider this for moral sake, or they think it has pretty similar returns, or you think oil and gas or tobacco is a dying industry, I feel like this ETF would be the one to go to. When I used to work at PNC, we try to advocate to our new clients and our current clients to invest in ESG funds. And some clients, they actually reach out to us and they say like, oh, hey, I heard about ESG investing. Do you have any products that you sell? Or, I don't want to invest in, I'm not a fan of oil, I'm not a fan of gas. Or they're not into mining companies, anything that's considered, against ESG investing. There's some clients that actually look for that. And this is why ESG is becoming more popular. A lot more people, a lot more investors, they're becoming more conscious about the environment. A lot more like compared to like now and 4 years ago, a lot more people are more aware and more active and motivated to help, prevent climate change or, mitigate climate change that's going on. These social issues that are going on, people want to, help out, and they help out with their investments. That is one of their ways. And that's why ESG is becoming so popular these days, is because of all the social issues, and a lot more people, they're, starting to become woke. They're starting to care more. So that kind of wraps up the my presentation about ESG investing. If you wanted to have more questions in regards to it, you can say in the chat, or you can unmute yourselves and ask. But regardless of not just this presentation, but anything regarding elections or any other questions you want to ask me about, or guys, thank you for coming. Really hope you liked the presentation. I thought it was pretty fun, pretty interesting. But and also we also accounted for everybody that attended. But does anybody not have any questions? That'd be all. And then I'll end the recording right here. And we ended at almost 5:30. That's really good timing.
Yo, that was great. Thank you.
No problem.